According to the USDA, forecast for the sharpest decline in U.S. farm income in history over 2023. I mean, they're down $42 billion. $42 billion in revenue in 2023. But when you look at what else they're going through, increased insurance costs, increased borrowing costs on their loans, taxes going up, labor costs going up, fertilizer costs going up, everything is going up. And then you look at what Walmart and Kroger are doing. They're building out their own facilities, moving away from farmers.
Indoor vertical farms have been touted for their ability to grow leafy green vegetables like lettuce in warehouses year-round.
Retail giant Walmart announced it's investing in indoor vertical farm Plenty as part of a $400 million funding round.
It will produce leafy green vegetables, and it's all run by robots.
This is unreal. What we're walking into, we've never seen before in U.S. history. I'm going to break it down for you.
That is a formula for a gradually weakening economy, not a big break in the economy, a slowing of that economy. I think that's what we're seeing. And as a result of that, that's what you're seeing in the bond market, as there's a bit of a easing within that range.
Many Americans, many people in my state, have to sell blood plasma in order to go to the grocery store.
It's no longer news that government debt in the United States reached record highs this year. Previously, on December 16, 2021, the debt ceiling was raised to $31.4 trillion. However, barely 2 years later, by January 19, 2023, the federal government had reached this threshold. Subsequently, the Treasury initiated extraordinary measures to facilitate additional borrowing room, leveraging its current cash reserves and incoming tax revenues. This strategic approach prevented the federal government from defaulting on its debt for an extended period. Finally, on June 3, 2023, policymakers temporarily lifted the debt ceiling until January 1, 2025. Since then, the debt has only grown astronomically and is expected to reach tens of trillions in a decade. Reuters reported, Republicans and Democrats are touting a hastily written debt ceiling deal that staves off a devastating U.S. default, but does little to slow a massive buildup of total federal debt now on pace to exceed $50 trillion in a decade. Where does this leave the economy, and what are the prospects for 2024? Well, navigating a national debt that has doubled in the past decade, reaching $33.7 trillion, approximately 124% of the GDP, doesn't require rocket science. The fundamental options involve increasing taxes, reducing expenditures, or implementing a blend of both. Whichever way, it is clear that massive layoffs are coming, and a plethora of bankruptcy announcements will follow. Let's dive deeper into the situation. A surge in corporate debt refinancing is anticipated in the upcoming year, with nearly 9% of the existing investment-grade debt set to mature. Unless companies decrease their capital needs, the necessity to roll over this debt at elevated interest rates becomes imminent. In September, Fortune reported about the likelihood of a recession in 2024 because companies were facing a huge shock of having to refinance debt at higher interest rates. Fidelity International's Salman Ahmed had a lot to say. The end point of the cycle is a recession because the transmission channel will kick in, he stated in an interview. If the Fed doesn't back off at some point, everybody has to pay these higher real rates. Following the years of loose monetary policy during the pandemic, corporations now face a multitude of maturing debt amid a new era of higher interest rates. According to Ahmed, who contributes to the asset allocation strategy for Fidelity's $47 billion multi-asset business, the delayed effects of the central bank's tightening will be the catalyst that eventually tips the economy into a downturn. Borrowers are not feeling the full pressure of the interest rate because they are sitting on locked rates, which is not a permanent phenomenon, he explained. A company which financed itself at 2, 3, 4% is going to be financing at 10, 11, 12% now. That's a huge shock. The heightened expenses linked to servicing this debt generally limit a company's ability to invest in its operations and compensate its employees adequately. Many businesses may find themselves compelled to make significant decisions, and Goldman Sachs foresees the coming ugly wave too. Earlier in August, they had warned that the U.S. was facing a $2 trillion corporate debt wall. The bank issued a warning, stating that the heightened interest expenses linked to the refinancing of U.S. corporate debt will result in a decline in capital expenditures and the potential loss of around 5,000 jobs monthly in 2024. This figure could escalate to 10,000 jobs per month in 2025 if interest rates remain elevated at their present level.